Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, February 3rd, 2023, and this is our monthly market monologue where we are going to go into a little bit more depth and talk a little bit about the bullish start to 2023. We're also going to talk a little bit about how some bonds actually outperformed some stock indexes, some big stock indexes that you know, in the month of January. We'll talk a little bit about that. We're also going to look at some of the economic data that we are looking at that seems to suggest to us that we might not see a technical recession in 2023, despite the high number of professional economic forecasters who are predicting a recession. So we'll talk a little bit about that. Before going any further, we want to stop and encourage you to make sure that you hit the like button here on YouTube or on Facebook. If you're on YouTube, also please make sure you hit the subscribe button. We would love it if you would do that. We also read all of the comments that you leave us, so please feel free to leave us a comment on either platform. Those types of actions do help the algorithm, so we would appreciate your assistance in that regard. That said, feel free to share these videos with others. We do have capacity to serve other clients, so we would love it if you would share our content with others. We would be more than happy to see if we can be of assistance to them. That said, a couple more housekeeping items. It is now tax season, and if you are a client of ours, 2 points in this regard. One, we expect most, if not all, tax documents to be available by February 24th at the latest. Some of them will be available sooner. But really want to wait until February 24th before we spend too much time preparing taxes, because the documents just are not going to be ready in time. That said, we do have a new client portal, and pretty excited about this. Pretty pleased at how this has turned out. It looks really good. It's very simplistic, easy to use, etc. So we are slowly getting clients enrolled in our client portal. If you are a client and would like access to the client portal, feel free to send me or Karen an email and we will get you access to that portal. Otherwise, we'll be handling that for you in one of the upcoming service appointments with your lead advisor. And then finally, I would be remiss if I didn't go ahead and mention the upcoming V Foundation Victory Ride to Cure Cancer. Last year, we put together a cycling team and participated in this event. I think I had about 10 riders on the team. I'm hoping to have another 10 this year. So if you are a cyclist and you'd like to join us in that team, please feel free to reach out to me. We'd love to have you on the team and go cycling with us. That said, the V Foundation Victory Ride to Cure Cancer is obviously about raising money to cure cancer. Over the last 25 years of doing business, I've had a lot of clients who have been affected by cancer, some of my family as well, and then obviously the extended family and extension of clients and their family that have been affected by cancer. So this disease affects a lot of folks, and this is one of the reasons why we participate in it. It is also important to note that 100% of money raised through this ride goes directly to cancer research. Not a dime of money raised from this event goes to fund the V Foundation's overhead, and that is really important to me because I want to be efficient and effective with our giving. So last year we raised just north of $10,000. This year I've put our team fundraising goal at $12,000. I myself am going to attempt to raise $3,000. If you would be willing to contribute to those efforts, we would be honored by your generosity. We will put the link in the comment section below. If you would like to make a secure donation, we would be so honored. That said, all those disclosures and housekeeping items out of the way, let's dive in and start taking a look at the S&P 500. On the screen, we have the S&P 500 for the full year, and we can see that the year started right here. And so this is 2023. We're going to zoom in a little bit because I really want to highlight this level of 4,100 on the S&P 500. Now, this particular chart, again, I'm recording this on Friday, February 3rd, but this is a month ending of January. So this is the last day of January. And I want to highlight how important this level is, and we're going to zoom in and look at it on a monthly candle chart, and it's a little easier to see how important the 4,100 level is on the S&P 500. Now, the good news is that we did close above 4,100 just the other day. Yesterday, it came. We also closed above 4,100, and so after a very strong week like this, it would not be surprising if today, Friday the 3rd of February, we saw the market come in a little bit. Well, if the market does come in a little bit, what I'm going to be particularly looking for is whether or not we remain above 4,100 on the S&P 500. So a good start for the S&P 500 for January. Again, you can see these monthly candles. A very bad December. We were, based on the seasonality charts, December tends to be a good month. This December 2022 was not a good month. Well, January is kind of recovering that. So a good start for the S&P 500. Looking at the NASDAQ now, you can see in this case, the NASDAQ recovered even and closed higher than December started. So a very strong month for the NASDAQ. When we look, however, at the daily candle chart for the NASDAQ, you can see it doesn't look as healthy. It has just recently come up above the 200-day moving average. That's the black line, and that again is the demarcation line of where most technicians would indicate, hey, this is now in an uptrend because it is closed above this 200-day moving average. But if we flip back to the S&P 500, you can see the S&P 500 has been above this 200-day moving average for a little bit longer. So the S&P 500 seems to be a little bit healthier than the tech-heavy NASDAQ. We can also see, again, this 4,100 level, how it looks like we're closing above these November and December highs. Very strong start. How strong was the start to 2023? On the screen, we have a seasonality chart, which is showing us the average performance for the S&P 500 broken down by month since 1950. And we can see that this is your average January. How strong was this January? Quite strong. This is a reminder of how tough 2022 was. This is all years for the S&P 500 since 1976, with the bold red line being 2022. So that's just a reminder of how tough the year was. Breaking this down further, we want to show you that the S&P 500 was down about 19, almost 20% in 2022. You had the NASDAQ Composite Index down a little bit more than 33%. And then this is long-term Treasury bonds, also down about 33%. Remember, many believe that bonds are quote-unquote a safe investment. And if you reach a certain age, you should be quote-unquote more conservative in your portfolio. And traditionally, people would use bonds as that conservative holding. Well, evidence suggests that that is not necessarily always wise, and active management might be more appropriate, which is certainly what we believe. Now, how did all of these three measures do in the month of January? Well, flipping the screen to show you what happened in the month of January, I want to show you that bonds actually outperformed. You see the TLT measure up 7.6%. More than the S&P 500. Not as good as the NASDAQ, but TLT certainly had a very good month of January. We also want to show you a little bit more about how bullish was January, how bullish was the start of the year. These are the various sectors of the S&P 500. And what we want to show you is, in particular, I want to highlight the top performers. The discretionary sector, this is the communication sector, and this is the tech sector, and then look at real estate. In particular, look at those same four and how they did last year. Look at the bottom of the chart now. This is those same sectors for 2022, and what do you see? The worst performers for the month, for the year of 2022, consumer, that's communications, that's discretionary, real estate, and technology. So for the first month of this year, the top performers were the worst performers for last year. So we have shown that January was a very bullish month, a very bullish start to the beginning of this new year. But the question we ask ourselves is this rally healthy? So we're going to look at a couple of what we call breadth measures to answer that question. Now, on the screen is one of my favorite ways to look at this, and we have three different measurements on the screen. The top pane is the S&P 500, so that's what we've already been looking at. And then we have the percent of the S&P 500 that is above the 20-day simple moving average, then above the percent of the S&P 500 that's above the 50-day moving average, then obviously again the 200-day moving average. And in particular, I want to look at this here. Remember, the 200-day moving average is that level that most technicians would use to indicate whether a stock or an index is above trend or below trend. In other words, is it trending up or is it trending down? So we want to see a very good measurement of stocks that are above the 200-day moving average. And we've been talking about this for a while now. And you can see that we are now at 68%. Actually, this is from a couple of days ago. So 68% of the S&P 500 is above the 200-day moving average. Folks, that's very bullish. Another way that we look at this is looking at what's called the advanced decline line. Now, in this case, I've got the S&P 500 on the bottom pane, and on the top, I've got this advanced decline line, and you can see the watermark. It says NYSE. So technically, this advanced decline line is for all the stocks that are traded on the New York Stock Exchange. However, last year, we were talking, I guess this is towards the end of 2021 into the beginning of 2022, we were highlighting this bearish divergence. We were showing at the time that the S&P 500 was still going up, but the advanced decline line was going down. So let me give you a refresher on what this top line is. Advanced decline line is simply the number of stocks that are advancing minus the number of stocks that are declining. So if the line is going down, that means more stocks are declining than are advancing. So here at the beginning of 2022 and at the end of 2021, the S&P 500 was still going up, but we were warning folks and making defensive positions because more stocks were declining than were going up. That was a warning sign. So let's fast forward to look at what this tells us today. So here we have the S&P 500 again at the bottom, and you can see that we're right at that level. Now again, we've broken through this level in the last couple of days, but this trend line that I've got drawn is showing you that right at the end of January, the S&P 500 was right at these highs from November and December. But what was happening underneath the surface? Well, you can see the advanced decline line was indeed advancing. So more stocks were advancing than were declining. That is a bullish indicator, and that's very good news for us to see. So let's begin to land the plane by looking at a few economic indicators that are suggesting to us that we might not actually see a recession in 2023. Now, if you watched the video from last week, we posted the full webinar that we hosted for the Moore County Chamber of Commerce, and we had Dr. Michael Walden talking. And Dr. Walden, very well-recognized and well-respected economist here in North Carolina, and he suggested that we might see a recession in the third and fourth quarter of this year. And that's largely in line with the consensus view, is that we will see a recession. Now remember that in 2022, we saw negative GDP in the first and second quarter. However, it was pointed out by many that those contractions were very minor, and indeed they were. GDP was barely negative in first quarter and barely negative in the second quarter, and so the powers that be at the National Bureau of Economic Research has so far said that that was not a recession because the economic contraction was mild. And so now if we have the consensus view of economists that we will see a recession, the implication is that if we see negative GDP, it would be greater than what we saw in first and second quarter. At least that's what it seems to be the consensus. And I believe we talked about this recently, that right now we see the highest ever percentage of professional economic forecasters that are calling for a recession in the next 12 months. The fact that we are at all-time highs in terms of percentage of economists that were predicting a recession, in my view, that very well could be a contrarian indicator because economists as a whole, as a group, do not have a very good track record of calling recessions. So let's take a look at a couple of data points that we're looking at that seem to suggest that that might not be true. Well, one we've already looked at. The stock market is a leading economic indicator. And as we've discussed in the last several videos, historically speaking, the stock market does not bottom before a recession starts. And so if we're not in a recession, but we're going to see a recession in 2023, that would suggest that the stock market will go back down and will bottom and at or below that October low. So if we're not in a recession, but we will see one, we have some reason to be very concerned about our investment portfolio. But that's not what the stock market is telling us. We just showed you the bullish start to 2023 and a lot of the confirming evidence to tell us how strong this rally actually is. Well, the stock market is a leading economic indicator. So the stock market is suggesting that we don't see, or the stock market investors do not see a recession in the near term at least. That said, earlier this week, the Federal Reserve announced that they were going to raise interest rates another 25 basis points. The question is, does the Fed need to slow down? So now we're looking at this 10-year minus 3-month yield curve. If you've been watching our channel, you know that this is one of the ways that we look at whether or not we're going to see a recession is this 10-year minus 3-month yield curve. So when the math is negative, that's a yield curve inversion, and you can see that it goes negative before a recession. It goes negative before a recession. It has a 100% track record. And we've talked about how Dr. Cam Harvey from Duke University has actually recently been talking about how this yield curve might very well be flashing a false signal for right now. Well, the point that I want to make before moving on is where we're at right now on this yield curve. Again, this is just me zooming in. It's gotten worse in the last 30 days. And so this yield curve would seem to suggest that a recession is indeed coming. The yield curve inversion, you can see that it inverts sometimes well before a recession happens. So what this might be suggesting is that a recession may be in the cards, but it might not happen this year. Now, earlier this morning, Friday the 3rd of February, we got an update on the unemployment rate. That's on the screen right now. And this chart is actually not updated for the latest statistic. The latest statistic is that the unemployment is at 3.4%, and that is represented by the green line. And if you follow that line all the way to the left, we haven't seen 3.4% unemployment since the late 1960s. That is a very strong statistic, which might suggest that, and this is one of the reasons that Dr. Harvey has been talking about, that maybe that yield curve inversion is flashing a false signal, is because typically speaking, when we have a recession, we have increasing unemployment. And right now, our unemployment is still going down. We know that one of the biggest challenges that we have all been facing in this economic climate is the record high inflation. Well, on the screen right now is a copy of the news release from the Bureau of Labor Statistics. You can easily find it online yourself if you'd like to read the full report. But what we want to highlight is the makeup of the number that gets printed. I think we're at 6.5 or 6.7, something like that right now. Well, that's the annual year-over-year change. Well, that is made up of the month-to-month statistics. And what I want to highlight for you is the fact that those month-to-month statistics are going down. And so you can see that since June, we see a declining trend in these numbers. And so if that trend continues, the annual inflation number should indeed continue to come down. And that also colors our rationale for why we think we might not see a recession in 2023. Well, that will wrap it up for today. I thank you for watching. I hope you have found value in this and all of the other videos that we produce. If you have any questions, by all means, feel free to contact me or any member of our team. The website, Hicks-Associates.com. Feel free to reach out to us. We do have the office in Cary as well as one in Southern Pines. And obviously in today's digital age, we work with clients anywhere. So again, thanks for watching.